Most traders load this indicator, see green, click buy. See red, click sell. And then sit there wondering why a setup that looks perfect on the chart keeps failing in real trades. Because the super trend oscillator is not broken. What's broken? It's how it's used. Traders treat it like a traffic light instead of what it actually is, which is a filter. Green doesn't mean enter now. Red doesn't mean exit now. And until that collects, nothing else matters. Before we build this into a mechanical system, and this is strictly a mechanical explanation, let me be clear. Nothing here is financial advice. I'm explaining how the setup works, not telling you to trade it. With that out of the way, let's go straight to the chart. At the bottom, you have the oscillator. On the surface, it's simple. Above zero line, momentum is bullish. Below it, momentum is bearish. Most traders stop their thinking right there. They assume momentum equals direction and direction equals profit. That shortcut is where the losses began. On the chart, you have the super trend ribbon. Green suggests buying pressure, red suggests selling pressure. And if you trade nothing but those color changes, you probably lived through this exact moment. The ribbon flips green, you buy. And a few candles later it flips red, you sell or reverse. You place a stop, price spikes, and you're out. Money gone. The indicator didn't fail. The context did. That loss happens because traders react instead of position. They never ask whether the market is even allowing that trade to work. So the first adjustment is inside the indicator itself. And the super trend oscillator settings, the ATR lane should be set to 90. The oscillator smooth should be set to 27. This isn't about making it fancy, it's about slowing the signal so they reflect real momentum shifts instead of noise. Even with that done, you're still missing the most important piece. You need a hard rule that decides whether a buy or sell is even allowed. So add the 10 and 1 different moving averages indicator to your chart. From it, focus on a single line. Set it to EMA with a length of 300. Make it thick, make it obvious. This line is not an entry tool, it's a permission line. Once it's on your chart, everything changes. When price candles are above the 300 EMA, the trend is up. Sell signals stop being opportunities and start being traps. When prices below the 300 EMA, the trend is down. And buy signals are the ones trying to pull you into counter trend trades. You're not trading super trend color changes. You're trading pullbacks inside an existing trend. In a moment, I'll walk you through the sell setup step by step. And stay with me, because right after that, I will flip it into a buy setup. And that flip is where most traders get it wrong, even if they think they understand the sell. Now look at the sell scenario. Price is below the 300 EMA, so the trend is clearly down. The super trend ribbon is above price and red. Sellers are in control. You do nothing yet. No chasing, no guessing. A pullback begins. The super trend ribbon flips to green. and the oscillator moves from below the zero line to above it. This is where the impatience destroys the count. Most traders sell here or panic out of early positions. You don't. This is not a sell. This is the reset. You wait, let that moment breathe on the chart. When the pullback finishes, the super trend ribbon flips back to red. The oscillator drops back below the midline, so momentum has changed with the trend. Still, you don't jump in immediately. You let the price drift slightly closer to the red super trend ribbon. You're letting price come back into a structure, then you wait for the trigger. Pause here again on the chart. And then it happens. A bearish engulfing candle forms into the area. That candle is your entry. The stop loss goes slightly above the red super trend ribbon, not a random number, slightly above a structure. The target is set at 2 times the risk. Fixed, mechanical, no negotiation once you're in. That's the entire sell logic. Now fill up your thinking, because this is where people mess it up. A buy is not a new strategy, it's the same structure in reverse. Price is above the 300 EMA, so the trend is up. The super trend ribbon is below price and green. Again, you do nothing at first. A pullback starts. The ribbon flips red and the oscillator drops below the zero line. This is not a sell. This is the reset phase in an uptrend. You wait and let the chart show it. When momentum returns, the super trend ribbon flips back to green and the oscillator moves back above the midline. Price pulls back slightly toward a green ribbon, then you wait for the trigger. A bullish engulfing candle forms into the area. That candle is your buy entry. The stop loss goes slightly below the green super trend ribbon and the target is 2 times the risk. Same rules, same discipline. When traders lose with this setup, it's almost never because the indicator stopped working. It's because they skipped the permission step, rushed the reset, or tried to predict instead of letting the market confirm. This works when you respect trend, wait through discomfort, and only enter when momentum, structure, and direction line up. If you leave before the sequence fully plays out, you miss the part where the setup actually becomes consistent.